Today, I'm going to talk about U.S. stocks.
Stocks. Okay, we got the Trump dump, which I talked about already. 900-point plunge. How long did it take him to reverse himself? A day, it turns out. Trump has to have the stock market going up all the time. Of course, the 50% of Americans who own no stocks won't ever aren't affected at all. But I still don't see any major crash as long as you have overnight interest rates of 1.75% and a 10-year at 1.75%, with essentially free money, and that's actually negative interest rates on an inflation-adjusted basis. Buying stocks is the no-brainer trade here until it isn't. With the market devoid of fundamentals, every market move is now politically driven, unpredictable, and exaggerated. In other words, it's all a trader's worst nightmare, causing you to tear your hair out. Fortunately, I don't have as much hair to tear out as I used to, but I've seen these markets before and I know how to play them. Just watch for the trade alerts. Buyers will be now much more cautious going into year end. The melt up is over. Look for range trading with the recent highs as the top end of the range. Continue to focus on biotech and big tech, the market leaders. Global funds are moving out of cash back into equities. That's another topping indicator. The allocation has moved from 47.5, the August low, to 42.9 on cash. Bottom line, marginal new highs, then a 7% down market for the next 3 months. The new highs propelled by ultra low interest rates and a China trade deal. And here is the big concern, and this is why everybody's so nervous and late to get into the market. We are approaching 16-year highs on a price earnings multiples for the S&P 500 of 20. The last time we were this high was back during the dot-com boom when we actually got up to 25 for the main market. And of course, that began a 10-year downtrend to 2009, the Obama low, and multiples dropped by 60%. From 25 down to 10. It actually was 9.5 on an intraday basis in March 2010. So we've essentially doubled multiples. The scary part is the recent move from 14 to 20 has happened in the face of zero earnings growth. So you're paying twice as much money for the same earnings you had a year ago. That never ends well. So Bill Davis, we called the breakout. Looks like we got about 5%, which is a classic breakout amount. Now what do we do?
If you recall, John, last webinar, I had said that I fully expected a move up to 31 and a quarter. We took it out, okay, as expected. And, we were looking for a move to roughly 31.64, and we got to 31.55 before this downdraft. And, I'm not going to go through all the machinations of the exact numbers, but, my readers pretty much are very influenced by the factors involved here in terms of calling these turning points. Where do we go here? I fully expect another retest of 31 and a quarter. And if we break through it, then we're going higher.
Right. And we caught that bottom yesterday, buying the low down here at 308, essentially, in a 297-302 bull call spread. It expires in 12 days. And here's the method to my madness. You got the 50-day moving average at 302.87. So I put my upper strike at 302, went down 5 points for the long leg, and we'll make about $1,000 on a $10,000 position in 2 weeks. That's 10% in 2 weeks. If I had been aggressive, I could have gone with a 298.303, but with stocks this expensive, you'll always want to take, given a choice, you always want to take the more cautious position, and that seems to be working for us well. And we've been doing this all year long. It's worked every time in the SPYs. Okay, Bill, here's your Dow chart. Any great insights here?
Well, I think it's pretty much the same pattern. Follow the S&P for the lead here. I think that's really what you want to follow. But if you look at these charts, I mean, you can take the names off, and they're pretty much the same. Cross
Right.
out the price levels, but they're mirroring each other. I prefer, quite frankly, to focus more on the S&P, the larger index, a little more
Yeah,
market wide.
and that's what most professionals do.
Sure.
So let me ask the question that I'm getting almost every day now. Are you expecting a market crash?
A crash? No. But I do expect a meaningful pullback. But quite frankly, right now, I do not see those conditions in place for that meaningful pullback. Market is still too strong, and it's showing, every time I think we're going to get that meaningful pullback, the market turns around and reacts positively. So to answer your question right now, no. I don't know what the news event's going to be coming out of left field. Maybe it's a total breakdown of some sort of trade negotiations. I don't know what it is, but something's coming.
Yeah, when Trump says your mother wears army boots, that we're really in for trouble. If he says that to the Chinese, it'll be all over. And again,
something crazy like that out of Washington.
yeah, right. With negative real interest rates in the U.S., you're essentially getting free money to buy stocks and then collect the dividend. It's a no-brainer. Russell 2000, we had a breakout that lasted 3 days. We've given it back up. We'll see if they make another run at it. Keep in mind, this is lagging very badly because it has very heavy weighting in small oil stocks. I think maybe 40% of the Russell 2000, which by the way is only about 1,500 stocks now, is represented by oil industry, which has been this year's worst performer. NASDAQ, unlike the other charts, is much stronger. That's because big tech has been leading all the way. Very little pullback and first to make the big bounce yesterday. VIX, yeah, there's your 67% move in one day, or actually 3 days, from 11 to 18. Of course, people couldn't short this thing fast enough, so you had all the short sellers pouring in there yesterday at the close, and we dropped 2 points even before the day was over. And if I had been thinking, if I were a younger man, you might say, I would have been buying the long-dated June 2020 VIX $20 calls. I think we got a double in those over the weekend from the Friday low to yesterday's high, and we will do that trade again. But your timing on those has to be perfect, otherwise the time decay will kill you. Microsoft, we kept our long position through the sell-off. We knew it wouldn't drop enough to hurt us really, because we're so far in the money on this, and that turned out to be true. And today we're getting a pretty decent move up. Let's see. Okay. Let's see. Microsoft up 44 cents today. Was up more. We're going to run this into expiration in 12 days and ring the cash register one more time. And Microsoft has been very kind to us this year. We've had long positions almost every month, and all of them have worked. So again, run it into expiration, take the max profit. Facebook also breaking out. We're almost up to double top territory on Facebook. It seems the more people hate this company, the faster the stock goes up. And they are now openly admitting they are in the publishing of lies business, and it's up to us to decide who is telling the truth and who isn't, which is a total cop-out, which is great for shareholders of Facebook. Apple, boy, if I had time to get off a fourth trade alert yesterday, this would have been it. And the no-brainer there would have been a 240, 245 call spread in December. If we get another dump this week, that's exactly what I'll do next. The uptrend here is still very strong. It seems to be on its way to $300, and When it gets to 300, I'll probably raise my target to 400. The fundamentals of this company are so strong. $1.2 trillion market cap. Google, of course, you have a little heart attack when you're long a stock and the founders resign. In this case, it turned out to be good news because Sergey Brin and Larry Page have effectively been retired now for several years, handing over the real day-to-day operation to the new CEO. So when you retire and the stock goes up, that's kind of unfortunate. But again, keep buying every dip in this stock. This thing should be worth at least $2,000. Another 700 points in this thing minimum. Buy Google on dips. Amazon seems to be caught in a retail mire, and the fact that Target and Walmart have both figured out how to crack into their business. So Amazon's going nowhere. We've made good money on it this year. I think I'll stay away as long as there are better fish to fry. PayPal still coming back from that resignation, and we've been buying that on dips with the tech letter. NVIDIA, we pretty much missed the chip stocks this year because the volatility is so enormous. We were able to make huge returns by taking big positions in the safe stocks like Google and Microsoft and Boeing for that matter. This is a good sector. I expect to see new highs again, but again, the risk is much higher than you'll get with a Microsoft. Micron Technology, same deal. Great performance this year. The whole sector's up 50%. Salesforce announced fantastic earnings yesterday, and you saw that big move up. I missed this one. It's been range trading all year, but we had plenty of other great names to buy. Boeing, we jumped in again, and buying each one of these major dips is a formula for making money. We're along the 310, 330, expires in 12 days. We'll run that into expiration. Walt Disney, boy, opened for business, no kidding. Frozen 2 opened over the weekend. My kids saw it twice. One of the biggest animated movies of all time. With 5 kids, I can tell you I'm so sick of princesses, I never want to see it again. But, great for shareholders. Keep buying the dips in Disney. It looks like the numbers so far in Disney Plus streaming service are much better than expected. Adobe, we got into this at the absolute bottom with the tech letter and been running it ever since. That's been a great performer for us. Industrials really took the biggest hit on the Trump dump, and that's because they have the worst fundamentals. And they're being bought as value stocks only because there's nothing else to buy. They're so cheap. I'm not touching it here, but I might get tempted in a little bit lower down. U.S. Steel's poster boy for the industrials managed a nice little 40% rally off extremely oversold levels, but don't want to touch. Walmart, you can see the earnings came out, got that big pop up. We got out a couple of days before then, took profits on a bear put spread. If we'd kept it, we'd be getting the maximum profit now running into the expiration. So want to stand aside on this one for the time being. We've essentially been flatlining for 2 months, except that one day, which we managed to miss. Macy's won't rally enough for us to sell into, but I really like their Thanksgiving Day parade with all the balloons. Tesla, getting a lot of questions on Tesla these days. Should I be buying this rally? And the answer is, this is such a volatile stock. Anytime you play late, you are punished severely. So we put out aggressive buy recommendations last June at 180 and at 200 and 220. I wouldn't touch this unless we get another shot at 200. It is still a wildly overvalued stock at this point. PE multiple of around 90. You don't want to buy it until it breaks to a new high, which is going to be around 400. And just to show you the risks involved in this stock, I'll show you the 10-year chart, which shows the trading since the IPO. You can see at the very beginning, it had an IPO price of 30. We bought it at 16.5 after the collapse. Went straight up after that, and we've really been stuck in a range now for 5 years. Bill, what would you do? What would you do with a stock like this? I mean, monster pop, 5-year sideways move. In the meantime, the number of cars they produce have gone from 1,000 to 1 million.
To be honest with you, John, the only way you can trade this stock is just trade very short-term time frames. Look for your oversold, overbought conditions, and go in there. I mean, look, the swing last week was a $30 swing. It's a beautiful swing if you caught it. Okay, but the problem with Tesla is because of the price and the volatility, your options are extremely expensive.
Yeah, right.
That's where you get clobbered.
Spreads, you can make a lot of money while limiting the risk. And that's what we
correct. Which is the smart way to trade that at this point.
Thank you for saying that smart word. You can see the last couple we did here. Last June, we bought the 140, 150, and we were paid an enormous amount of money to take that position, even though it was $30 out of the money. And we got a double after that. And then we played the short side, and that worked. So this stop back here, that cost us 2%. And that's what happens when you trade this kind of stock. The stock kept rallying going into the pickup truck launch. So we got out of that, took our loss. And of course, the day after the pickup truck actually appeared, it went back down to the 230 level. So if we kept on to that, that would have been a winning trade. And that is the risk of trading this kind of incredibly volatile stock. Southwest Air at the highs, and that's the largest buyer of the 737 MAX. So this suggests that we're getting very close to relaunch of the plane and the end of the grounding. Getting less action from Delta, which doesn't use 737s. Transports still trending up, but had a scary sell-off there. Don't want to touch. Healthcare, boy, just straight up every day. I mean, everything we recommend just seems to go up every day. We've recommended several of these, Pfizer, Merck, and AMZN, and the future is fantastic. We're 2 months into a 10-year bull market on this entire sector. This was the auto trade alert that went out with the first biotech letters at the end of September. It is up 21% in 2 months and still has a long ways to go. This is the best performing biotech trade alert, up 100% in 2 months. And this also can keep going substantially. The future is in CRISPR technology. And we are having a sale on the biotech letter, a Christmas sale, good only this week. And if you want to subscribe at a discounted price, send an email to customer support and we'll take care of you. Biotech and tech is the future. You want to get specialized letters on both sectors so you know exactly which names to focus on. Goldman Sachs hasn't really broken out, had the biggest fall on the Trump dump, seems to be more range trading. And this is really how you pick winners to buy on the next sell-off. The ones that have the biggest sell-offs you want to avoid because they are losing their long-term uptrends. The ones that have the smallest sell-offs are the higher quality stocks, which people are still trying to buy. So another lesson there in basic trading 101. Bill, are you doing anything in financials?
No, not at this point. No.
Yeah, you had your dead cat bounce. I'm not sure I'd want to chase them up here. The stock is essentially exactly where it was a year ago during one of the greatest bull market years of all time. Let me get some questions here. How bad will it get for car makers, and will the Tesla plant in Germany affect sales for European cars? European car makers have already been badly affected by Tesla, with Tesla taking over practically the entire luxury end of the market. That's why companies like Mercedes, Audi, and BMW are doing so badly with their shares. And they're so far behind, it's unlikely that they'll ever catch up. The Berlin factory, I think, is a battery factory. Next for them will be a production factory, probably somewhere in Eastern Europe where the cost basis is much lower. Consumer discretionary, sideways move, don't want to touch. And this is even with Disney giving a major push to the sector. These other names like Amazon, McDonald's, and Starbucks have essentially been going nowhere. And another question here from Bill. Jeff Goodlock says the U.S. will get crushed in the next recession. Do you agree with him? Well, my first advice to you, never take stock advice from a bond trader. Jeff Goodlock makes these spectacular forecasts, but the timing can be terrible. He can be wrong for 9 months before they finally turn. So you can go out of business trading off of Jeff Goodlock's stock advice, although his bond advice is outstanding. It's like asking me for advice on fashion or manners or something like that. And another question, do you have any good recommendations for dividend stocks? Yes, look at the entire cell phone towers REIT sector. That will be a big growth sector next year with 5G, and they have very high dividend yields. Japan, flatlining since we hit the beginning of November. Stocks here are just too attractive for me to mess around with foreign markets yet. Emerging markets having a little correction that this is your major high risk play on a weak dollar, and we are getting a weak dollar, and I probably should be buying this, but I'm going to be very cautious going into year end.
I hope all of you found this helpful, and hopefully it has also improved your trading. This is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good trading.